Happy Friday, traders. This is Fawad Razakzada, market analyst with City Index. Today is the 12th of December, heading into the last major important week for the markets next week. Let's get into it. Following the Fed's rate decision early this week, we saw the US dollar and bond yields fall, but they are coming back up now, with the US dollar rising from that 155 key support level against the Japanese yen to head back to 156, which is where it's trading at the moment at the time of this recording. Investors are looking ahead to the monthly jobs report from the US, which will be released on Tuesday of next week. Then we'll have a couple of central bank meetings. Most importantly for this currency pair, the Bank of Japan will meet on Friday. So where does it go from here is the key question. And with the US bond yields coming back up, you'd feel the path of least resistance remains to the upside for the dollar yen. And a lot will now depend from a technical point of view in terms of what happens here at around 156, which is a key short-term resistance level to watch. If it breaks above it, I think that could pave the way for a run towards 156, possibly testing the November high of 157.90 ahead of the US jobs report. But if it were to get there, why stop there? It could even go to test the January high of 158.88 as well. So for the time being, the path of least resistance remains to the upside, and if it can break that 156 level, it could trigger further technical buying above it. In terms of the downside, then 155 is a very important level, because this was a prior resistance area which gave way during the rally in mid-November. This area was retested a few times last week. It held, and yesterday we tested it again and we bounced from there. So clearly there's a support there at around 155, and if that level were to give way for whatever reason, be it a weakness in US data or a very hawkish Bank of Japan next week, or indeed it could be intervention from the Japanese government to support the currency, any of those factors could potentially lift the Japanese yen and cause the dollar yen to break below this area of support. But from a purely technical point of view, this is where the line of the sand is for me. For as long as we remain above this area, the path of least resistance will be to the upside. A few moments ago, I shared this chart of the US 30-year bond yield on Twitter, or X, I should say, and I highlighted the potential for a possible breakout above this bearish trend line that it's testing at the time of this recording. Can it move above there? That's a key question. If it does move above this trend line and hold above it, this could potentially provide support for the US dollar, possibly against other currencies as well, but more so against the Japanese yen and other low yielding currencies. And we could well see a continuation to the upside in bond yields. For now, it looks bullish. The fact that it has broken the FOMC high is significant, and that the FOMC decision was deemed to be slightly dovish than the market had expected. Well, if that was the case, surely bond yields should have fallen, but they haven't. They fell, but have now bounced back, and some taking out this week's earlier highs. So keep an eye on the bond yields, because this could trigger all sorts of volatility for other financial markets. For example, the Nasdaq, where expensive technology stocks could be hit. On the back of some earnings disappointment from a couple of technology companies and the fact that bond yields have risen, we are seeing some weakness in the Nasdaq 100, which is quite significant. It hasn't managed yet to break above this resistance area that it nearly tried to yesterday when the other major indices in the US hit record highs. The Nasdaq didn't break through this area of resistance at around 25,850-ish. This level is very important. If it can break through that, then I think we could well see a year-end rally. But the fact that it's holding below it, and with bond yields rising, this could potentially spell trouble for the wider technology companies in the US, which is going to be very interesting to keep an eye on. So watch price action closely here, and in particular, keep an eye on yesterday's low when the market created a hammer-like candle. If that low were to give way, then that would put the bullish traders who bought on the back of this in a spot of bother, and then we could well see some liquidation of long positions, leading to some volatility into the next week when we have the US jobs report coming up. For more market updates and insights, head over to cityindex.com. I will see you in the next video. Take care and have a lovely weekend.